This is a video for HRA 310. It's for accounting, and it's to explain how I got an APV of 680.02 on the capital budgeting simulation. We did 5 years of investment choices for the New Heritage Doll Company, and the goal was to get as high of an APV as possible while using the investment tools that we learned in the capital budgeting section. So for this project, or for this simulation, we had to invest in a choice of, I think, 27 different projects, and we had to choose which ones would make our company profitable. So the way that I picked mine was by looking at the NPV, which is net present value, and you want that number to be as high as possible because the higher the number, it's going to add a higher value to your company. I also looked at the IRR, which is internal rate of return, and you also want that number to be pretty high, and that's just going to add more return to your company on that investment. And then one of the other numbers you want to look at is PI, it's profitability index, and that is another number that you want to be high. So the three numbers that you want to be as high as possible are profitability index, internal rate of return, and net present value, excuse me. So those three numbers by themselves aren't going to give you a necessarily accurate reading. So that's why you also want to take into account the payback period, which you want to be as low as possible, because that's going to be the amount of years that it takes to earn back the amount of money that you invested. And I also scrolled down and I looked at the earnings before income taxes, and I looked at that trend. So you want that to be trending upwards. So you want a steady increase, and you don't want any drops. So you don't want any drops, and you want it to be going up. So that guideline that I just gave you about looking at the earnings and the high numbers doesn't necessarily apply to all of the projects that we were looking at in this simulation. There are actually a few different kinds of projects. So this one, called the Design Your Own Doll, would actually be considered an expansion type of project. So that is one of the ones where you want all those numbers to be high and you expect them to be high. Other kinds of projects include the warehouse facility one. So this one would actually be considered a replacement project. So these kind of projects like replace pieces of the productions, so manufacturing and everything. So it would end up saving you money in the long run, but that means that the NPV and the internal rate of return aren't going to be as high now. So they're not going to actively earn you money, but they're going to save you cost later down the road. So when I was looking at projects, you want to definitely look at what type of project you're looking at, because when you're looking at a replacement project, you're not expecting to see high numbers. But you would definitely want to still look for the payback period and the internal rate of return, and you want to look at how much it costs over time. There are also other projects where in the first 2 years you don't necessarily have enough money to invest in both at the same time. So that would be called a mutually exclusive decision, and you would want to compare all three of those numbers that I had mentioned, the NPV, the PI, and the IRR, just to make sure that you're making the best decision for the money that you do have. And then there are also ones like growth projects, and you would want to, if the original project did well, then you might want to consider expanding on that project later with a new project. There are also a couple other things that you would want to look at before you make your final decisions in terms of which projects that you want to invest in, which ones you don't. You're going to want to also take a look at some of the NPVs, because I know I said that you want a high NPV, but sometimes the NPV might not be very high, but it is fairly high in comparison to how much you spent on the project. So this one, you would spend $0.18 million for an NPV of $5 million. So that would be a pretty good, and you would want to just take a look at that instead of just saying, oh, this doesn't have a very high NPV, it's only 5. You would want to take a look at, well, I didn't even spend $1 million, so that's a pretty big return. And then another aspect of choosing these projects was doing the project discount rate, and that's something where we could change the discount rates that we chose for these. And generally, for most of them, I chose the lowest risk, but for some of the low-cost projects, such as this one, I did go with a higher risk. So as you can see here, it's a retail division project. So I would choose one from the retail section. So the low risk would be 850%, and the high risk is 10%. So I chose the high risk 10% one, where it does have a lower NPV, but it's a fairly low cost, so I wouldn't be losing that much. Whereas some of the higher cost ones, I chose the lowest percentage because it's a high cost and I don't want to lose that much. And it also gives me the highest NPV out of all of the percentage options. So like I had said at the very beginning of the video, you don't want to use any of these tools of investment by themselves. You don't want to just look at the NPV, or you don't want to just look at the internal rate of return. You need to use a combination of the three of them and kind of take a look and see if all of them are good or if all of them are really bad. So they're usually very consistent and accurate when you take them into account altogether. And then you also, like I said, you want to consider the payback period. So once you make your final decisions, you want to go up here to the historical financials tab, and that's where I looked at the costs of what I was doing, and I kind of checked in every single time that I made an investment decision just to make sure that I was staying on track. So at this tab, you can see the company consolidated, and then you can also see for each division, you can see production, retail, and licensing. I usually just looked at the company consolidated part, just to get a broad overview. So what I also looked at, you have the income statement and you also have the balance sheet. You want to look at just the overall trend, just like you did before. You want to see that it's increasing as time goes on, so you want to start with a lower one and you want to end with something higher. And that goes for the earnings and for the net income and the assets. So you kind of, again, you just want to have it increasing, and you don't want any sudden drops like this. But this part is explained by the fact that this is the first year that I actually made a decision. So you're going to be spending money during that one. So you want to take a look at like what percent you increased. So this is about 25 to about 60. That's more than 100% increase. So that's a good thing. When you're done looking at the historical financials tab and evaluating whether you've done a good job making a decision in that aspect, you also want to go up to this income statement and balance sheet tab. And at this tab, you can see all of the future projections for your company, and it has the income statement and it has the balance sheet that you looked at the historical financials part, but this is projections instead of looking at the past. So as much as you want to look at the past and compare to how you have done, you also want to look at trends. So just like in the historical financials, you want to see that earnings are going up and you don't want to see any sudden drops. So that goes for earnings, net income, assets, pretty much everything. You want to see a steady increase, or at least some kind of increase each year. And this whole thing, you do really, like, without this knowledge of the tools of investment, a project might look really great and it might look like it's going to make you some money, but using those tools is really going to help you because it might end up losing you money. So you want to look at all three of those tools instead of just looking at one or looking at two of them. So you want to use all three of them. This whole simulation actually really helped kind of teach about resource allocation, because it was tough to figure out which projects we should invest in and which ones we shouldn't. So you really had to pick which ones would give you the best return for the money that you were spending, and you have to figure out which ones. You have to pick between the ones that will earn you money and the ones that will save you money, such as the expansion projects versus the replacement projects. And going along with the resource allocation thing, it also really helps with just budgeting and rationing out what money that you do have, because when you don't have as much money, you really take a closer look at what you're into buying. So it makes you prioritize and kind of evaluate closer each project that you might invest in more than you might if you had enough money to buy all of them. So that's been my video about capital budgeting and how I got the APV that I did. Thank you so much.